Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel, which will be a comprehensive ratio problem. We'll go through a comprehensive set of ratios, taking those ratios from financial statements, including balance sheet and income statement. We'll also be doing a two-company comparison. In other words, having a balance sheet and income statement from two different companies, comparing and contrasting the ratios from them. Get ready. It's time to take your chance with corporate finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area into our worksheet on the right-hand side. We're going to have two sets of financial data for A and B. We got the balance sheet and we'll have the income statement. So we got the two main statements, the performance statement being the income statement, balance sheet being the point in time where we stand as of a point in time. We'll then be calculating the ratios, breaking them out into categorizations. Profitability ratios, we'll be doing those for A and B. Profit margin, return on assets, return on equity, asset utilization ratios, the receivable turnover, average collection period, a second calculation or an alternative way to calculate, inventory turnover, we're using sales, and then we'll have the fixed asset turnover, total asset turnover. Then we have the liquidity ratios, including the current ratio and the quick ratio, and they shouldn't be populated yet, so they'll be unpopulated as of now. And then we got the debt utilization ratios, which is the debt to total assets and time interest earned. Okay, so let's take a look at our information on the left. Once again, we have our balance sheet and our income statement for the two companies, two sets of financials we will be comparing and contrasting. We're going to work with company A first, so let's go ahead and hide the second set of data. So that will be as close to as we can as we go through the ratios. Then we'll go all the way through again and do the same thing for B a little bit faster. So I'm going to put my cursor on E here so I see the drop down, I see the arrow. I'm going to select it and drag on over to H, even though that's a little skinny item, little skinny column. And then we're going to right click on that selected area and hide it. All right, and then we've got our balance sheet. Remember, it is assets equal liabilities plus equity. This is where we stand as of a point in time. Assets further broken down into current assets and long-term assets, otherwise known as property, plant, and equipment, or depreciable assets or fixed assets. And then we have the liabilities, which includes the current liabilities and long-term liabilities, and the equity section. Then we have, of course, the income statement, performance, how we're doing over time, including sales. That includes all credit sales. All sales are credit sales for this company. Cost of goods sold, gross profit, selling and admin, depreciation, operating profit, interest expense, earnings before taxes, the tax, then after tax earnings. All right, going back on up top, we're going to go right through these ratios, starting with the profit margin. So the profit margin is going to be calculated as net income compared to sales, and that's going to be our profit margin ratio. These are both income statement items. Notice we're talking about performance ratios here. So you would think we would be dealing with at least part of these equations on the income statement, because the income statement measures how well we did over time. So in this case, we're going to take the bottom line of the income statement, net income, income after taxes, and then we're going, the bottom line after all expenses. Then we're going to take the top line, which is going to be sales, and we're just picking up the sales up top. Now notice it says we would be picking up all sales, whether they be credit sales or not. Just so happens that all sales are credit sales here. And then we will be dividing those out. So I'm going to say this is going to be equal to the 84.7 divided by the sales. Let's go ahead and go to the Home tab, Numbers group, add a percentage, and then we'll add some percents here. We could keep going. I'm going to stop it at 2. Now, 6.31, what does that mean? Every dollar sale we have, we're walking away with about 6.31 cents, or for every $100 sales, we're walking away with about $6.31. Is that good? Depends on past performance. And on a comparison to the industry standard, we'll be comparing to B at a later point. So then I'm going to go to the Home tab font group and put a little underline here as well. Next, we're going to go to the return on assets, could be known as return on investments or return on assets, which return on investments would be ROI, return on assets, ROA. So a similar kind of calculation that we would be thinking about with a return on investment if we were thinking about like putting our money into something, a capital type of investment. This is a similar type of calculation in that we're going to be comparing our return, what we're getting over time, that being net income, to what we've put in, what we have in order to generate that return, which in the case of the business are the assets. So remember, assets equal liabilities plus equity. Assets are what the company has. Why did the company have assets? Because they're going to use them to help them generate revenue in the future. The goal of the company isn't to just have a stockpile of assets. That's not useful. We want to have the assets there in order to help generate revenue, the return being the net income. So also note that we're comparing an income statement account and a balance sheet account. So whenever that is the case, you might see this, depending on the context, calculated as net income divided by average assets, which would typically be calculated as the beginning of the period plus the end of the period total assets divided by 2. That will typically be the case anytime we're comparing something on the income statement and balance sheet due to the difference in timing. Income statement performance measures, balance sheet point in time. So we're going to then be picking up the net income, bottom line of the income statement. That's kind of our return that we're getting over time, and we have are getting that return based on our investment or what the company has in terms of assets, that being the total assets, the 773. Let's compare that. This is going to be equal to the 84.7 divided by the total assets. Let's go ahead and make that a percent. Home tab, number group, percent. Add some decimals. We could keep going. We typically stop at 2. Let's put an underline up top. We're going to go home tab, font group, underline. So we got 1094. So that's going to be a measure of how well we're utilizing our assets to get a return on it. Is that good? Well, it depends on past performance. How is it comparing up and lining up to past performance and industry standards? How does it stand up or line up to the industry standards? Then we're gonna take a look at the return on equity. So return on equity. Remember, our accounting equation is assets equal liabilities plus equity, or assets minus liabilities equals equity. So equity is kind of like the book value of the company. It's the assets minus what we owe to the third party folks. We're going to be comparing then our return, our net income, compared to that equity, kind of like the book value of the company. Now, once again, you're comparing an income statement amount, net income, to a balance sheet amount, the stockholders' equity amount, and therefore you might see this written as average stockholders' equity, the most common average being beginning of the period plus the end of the period divided by 2. So let's pick up the net income. Net income, once again, bottom line of the income statement, that 84.7. Then we're going to be picking up the equity section, total on the equity section on the balance sheet, basically the book value where we stand as of this point in time, dividing those two out, the 84.7 divided by the equity, making that a percent, going to the home tab, numbers group, percent, adding decimals. We could keep on going. We'll typically round it to 2. So return on equity then, notice we want these numbers typically to be higher. The profit, all these numbers might be nice to have higher typically better. But is that good? 15.31, how well are we getting a return on basically the book value of the company? Well, depends on past performance and on industry standards and industry trends that we will be comparing to, what we would want to be comparing to. So notice all these ratios, you got to, create a story. We're trying to create a story with these ratios. And so we have to have multiple ratios, and we have to be comparing them to relevant data to put together that story. So then we're going to go to the home tab, font group. We'll put an underline here. Then let's go to the asset utilization ratios. Asset utilization ratios, these are going to be a lot of our turnover type of ratios, a lot of turnover type ratios. And so we're going to be saying, let's look at the accounts receivable turnover ratio. So accounts receivable turnover ratio will be calculated as sales divided by the receivables. Now, the sales represents an income statement account. Receivables is going to represent a balance sheet account. Therefore, you could see the receivable once again having an average receivable. Anytime we see that being the case, we have a timing difference. So you might see this formula represented as average receivables, which would be beginning of the period plus end of the period divided by 2. We're typically looking credit sales here because we're trying to see how many times the receivables are turning over. All sales here being the credit sales, meaning all sales for this company are sold on account and therefore go through the accounts receivable. So also note that you might see sales saying net sales. If something says net sales, that don't get confused with net income, the bottom line of the income statement. Net sales simply means it's taking its sales after any kind of contra sales accounts, such as discounts or something like that. So those they act like expenses, but they're really kind of contra sales accounts. So we're basically taking the bottom line, sales category number. So sales number, which is the top line of the income statement. So that's going to be our 1,003,042. Then we're going to be picking up our accounts receivable on the balance sheet. So accounts receivable on the balance sheet, 184,4. We'll divide those two out. This is going to be equal to the 1,003,042 divided by the accounts receivable. Let's go ahead and add some decimals. Home tab, numbers, adding some decimals. We could keep going. I'll typically go to 2 decimals. So this is a measure of the receivable turnover, how many times the receivables are turning over. If they turn over more, that's typically better. So a higher turnover is typically better because we'd like these things to be turning over more. That would be good for cash flow. Is 7.28 good? Well, depends on past performance measurements and on industry standards as well as trends, our trends compared to industry trends. Now, once we have the receivable turnover, we might say, hey, I'd like to break that down to basically the average collection period or the days to collection. How many days outstanding is an average receivable? In other words, you could think of it. Because that is more of a standalone number where we can kind of think, okay, I can take that number and it makes more sense to me even without the context, or it makes more sense at least without the context of industry standards and past performance. So for that, we're going to take, there's a couple ways we can calculate it. We'll do it a couple different ways. One way, you could take the number of days, which may be 365, which would be a more accurate kind of number. Again, the days could vary depending on the year, but we can also try to even it out, which we'll try to do here by saying about 12 months 12 months exactly, times about 30 days to average out the months to make all the months kind of even for our ratio analysis. And then we could take that and divide it by the turnover. Notice when I divide it by the turnover, I'm going to the home tab, number group, adding decimals. I'm dividing by something because I'm picking up this cell with a formula. I'm picking up something that isn't exactly 7.28 because there is rounding involved. Then we're going to divide that out. This equals to 360 divided by the 7.28. Let's add some decimals. Home tab, numbers, adding some decimals. We're at the 49.47. Let's put an underline here. Let's put an underline here. So this would be in days, right? The average collection period in days that we would have there. So let's go put days there. Let's make this blue. Put a border around it just for the fun of it. Border it. All right. So that might make more sense in and of itself, but it still would make better sense if we were to compare it to industry standards. We can calculate this another way. We could say, okay, let's try to do this a different way. Let's take the accounts receivable net. We're going to do the same thing, the average collection period. Notice when we say accounts receivable net, we mean net of any allowance for doubtful accounts. So doubtful accounts is an estimating account to estimate how many of the accounts receivables will not be collectible. So if there's an allowance account, we want to make sure that we're taking the net, which would be the receivable minus the allowance. So then we're going to take the sales per day. So sales per day, we're going to be picking up the sales number on the income statement. So here's the sales number. These are all credit sales. And then we will pick up the days in the year, which we're saying, once again, we're going to estimate at 12 months times 30 days, or 360. That's going to give us a sales per day number. So we're going to say, all right, now we got the sales per day, which is going to be equal to the and let's move this up, let's say this number divided by the 360. And so there we have that. Now I'm actually going to move this one down a little bit because we got some space. I'm going to give one space between this item and the item above it. So what I'm going to do is to add a cell, if I want to do this, there's a couple ways we can do it. I'm going to do it this way. I'm going to select these 3 rows, and I want to add cells above it and push everything below it down. So what I'm going to do is I'm going to say right click, and then I'm going to say insert, and I'd like you to shift all the other cells down. So I'm going to shift all the other cells down. And so that shifted everything below it down, which shouldn't mess anything else up down below. So I think we're okay. So just to show a space between the accounts receivable and our little sub calculation down here. And then we're going to have our average collection period. Average collection period is going to be equal to this will be the 184.4 divided by the sales per day, 49. Let's add some decimals. Home tab, font, numbers, adding decimals. We could keep on going. We'll stop at 2. And there is our 49.47 again. Now we're left with an added row down here we don't really need. So I'm going to go ahead and delete this row now. So to delete the row, I'm going to select it. Don't delete the whole row. I just want to delete these cells and move everything underneath it up. So I'm going to right click on it. I'm going to delete. And then it's going to say I want to move everything underneath it up. So we're going to do that. And so there we have it. Okay, so next we have the inventory turnover. So inventory turnover, we're going to calculate it this way. We'll calculate it thusly. We're going to be calculating it using the sales number. Notice I'm pulling the sales number from the income statement, so it always says sales, which are all credit sales. So the sales are credit sales. But we're taking the sales number. Now note you might see the inventory turnover calculated with cost of goods sold, so be aware of that. Depends on the context of what you're looking at. And also, of course, we're comparing now a sales number to inventory. So sales is an income statement, inventory is balance sheet, therefore timing difference. Therefore, you might see this as looking for average inventory, which the typical average would be beginning of the period plus end of the period divided by 2. Okay, so we'll pick up the sales number for this item. So we're going to say this equals the sales number. And then the inventory is going to be on the balance sheet. So we'll go on over to the balance sheet, 57.4. Let's go ahead and divide this out, the sales divided by the inventory. Let's add some decimals, home tab, font group, adding some decimals. We could keep on going. We'll typically stop at 2. Going to put an underline up top. We're going to go to the home tab, the font and underline. So we have the 2738. So once again, this is a measure of how much we're able to turn over the inventory. Typically a higher turnover you would think would generally be better, because then we would be turning over the inventory more, and the more we turn over the inventory, the more sales we're generally generating for that. So we typically, but is 2338 a good number? Well, it depends on the industry and on our prior performance. Now we'll take a look at our fixed asset turnover. So this is going to be fixed assets like property, plant, and equipment. So once again, we're going to take our sales number. So that's going to be the income statement number. We're going to compare it to the long-term assets or the fixed assets or the depreciable assets. And notice that this is going to be an income statement number and a balance sheet number. So you may see this as the average fixed assets or the average depreciable assets or the average property, plant, and equipment. So we're going to be picking up the sales here. And then we're going to be picking up the fixed assets, which we have labeled here, property, plant, and equipment. Notice we have the property, plant, and equipment or depreciable assets less the accumulated depreciation. We're picking up the difference, or basically the net of them, the book value. So then we'll compare those two out. This equals the sales divided by the long-term assets. Then we're going to be adding some decimals, home tab, numbers, adding some decimals. So this is measuring the efficiency that we're using basically the long-term assets for at this point. So again, we would typically like these to be higher. These turnover ratios being higher would be better. That would be we would be more efficient at it. Meaning, if the sales was going up and we did it with less long-term assets, then we would be having a higher performance based on what we have, and that would be better typically. Is that good? Depends on industry standards, past performance. And then we have the total asset turnover. This is like the covering of all the turnover, of all the turnovers, right? Because total assets, we're taking a look at total assets now. So total assets, we're comparing the sales item. So now we're going to compare the sales item to the total assets. Once again, comparing an income statement item to the balance sheet item, which means we have a time frame compared to a point in time. So you might see total assets asking for, depending on the context of the problem, average total assets, which the most common average, which would be the beginning of the period plus the end of the period divided by 2. So we're going to be picking up the total assets up top. So we're going to say that's going to be the 7739. Let's go ahead and divide that out. This equals the sales divided by the total assets. Let's then add some decimals. Home tab font group, adding some decimals. We'll take it up to 2. We'll then underline up top. So once again, we're looking at the efficiency of the use of our total assets with this turnover ratio now. And the higher the ratio would be, the better. So we're comparing the sales performance. If the sales was higher compared to our total assets, what we used in order to generate the sales, I mean, if the total assets were lower and we can use less total assets to generate, higher sales, that would be better. So typically you want the turnover ratio to be higher. Is this good? 1.73 depends on past performance and on industry standards. Let's go ahead and hide some of these rows now, these columns I should say, because that would be the proper thing to say, so that we can look at the liquidity ratios. So I'm going to put my cursor on I. I'm going to select on over to L, even though L is really skinny. So I to L, and then I'm going to right click on the aisle, I to L, and we're going to hide them. All right, now we're going to move on to the current ratio. So this is probably one of the more common ratios. These are the ratios that bankers will typically use to see if they can pay off, trying to see liquidity, whether or not they can pay off their obligations. That's why we break out the current assets and the current liabilities. So we're going to take the current assets, which is going to be this number, divided by the current liabilities. And we will divide that out. This divided by this, and we'll add a decimal. Home tab, font group, add some decimals. We could keep on going. We'll typically stop at 2. So I'm going to underline here, home tab, font, underline. So we got the current ratio, 2.71, meaning we can pay off the liabilities 2.7 times with the current assets. Then we go to the quick ratio and you say, yeah, but what if there's some bad times and you couldn't sell the inventory? Could you still pay off the current liabilities, those liabilities that are becoming due within a year? Well, for that we can restrict the numerator of the ratio and now have it a quick ratio, or an acid ratio sometimes called, which we can call it the acid or quick assets, which are going to be the sum of everything but the inventory in our case. And comparing that then to the same liabilities. The current liabilities will remain the same. Comparing that out, this is going to be this divided by this. Quick assets divided by the current liabilities. Let's add some decimals. Home tab, numbers, adding a few decimals. We're going to stop it at 2. We're going to put an underline to the item above it. So we'll put an underline here. And so notice this number is always going to be at equal to or less than. If there's inventory involved, it will always be less than the current ratio. It's a more restrictive ratio. So we could still pay off the liabilities 2.21 times if we took out the inventory with our current assets. So that would be our liquidity ratios. You typically want them to be over 1, right? So that you still want to compare these to industry standards, of course. But basically, if they're less than 1, then you're concerned because then it doesn't look like you got the current assets to pay off your current obligations, and that's going to be a problem. So typically over 1, and generally across the board, and then you can compare industry standard. Then we're going to go to debt utilization ratio. How effectively are we utilizing debt? How effective is the leverage of the company? Debt to total assets is going to be comparing the liabilities to the assets. So these are 2 balance sheet accounts we're comparing now, so we don't have any kind of timing issues or average to this or that issues. Same with these items up top, by the way. Notice we didn't have any issues of comparing an income statement and balance sheet account. Therefore, none of this business of average items happening. So then we got the total liabilities. Total liabilities down here, 220. We're going to compare that to the total assets, the 773. This equals the total liabilities as compared to the total assets. Put in an underline here. We're going to add some decimals in and make this a percent. home tab numbers, we'll make it a percent, add some decimals to it. We're going to stop at 2, although we can keep going on it. Now notice the debt to total assets. If we look at our accounting equation, assets equal liabilities plus equity. Assets is what the company has. Liabilities and equity represents who has claim to those assets. So if you think about the liabilities compared to the assets, you're talking about the third party claim to the assets. You're looking at basically how leveraged the company is, how much of the company or the assets are owned by a third party, as opposed to the other percentage of it, would be owned by the owner. So there's debates on how good this one is. So you can compare this to industry standards as well, of course. But there's debate as to what is the optimal point of leverage as well. So that's a debatable topic that you can dive into if you so choose. So then we're going to go to the times interest earned ratio. So we're going to be picking up the net income before interest and taxes, and we're trying to see how many times over the interest can be paid. This is an income statement item, so where we have the interest expense here at the 10,000. And what we're going to do is you could calculate this two ways with what we currently have in a multi-step income statement. You could take the net income, back out the taxes, back out the interest. And if you do so, you will get to, because we have a multi-step income statement, the operating profit of the 164. So I'm going to say this is going to be equal to then the 84.7 minus the taxes minus the interest. And so that gives us basically our performance before. Did I do that right? Yeah, that gives, let's do that one more time. This equals the 84.7, I'm sorry, plus the taxes, plus the interest. To remove them, to take them out, we have to add them back in because they decrease the number. So that makes more sense. That takes us to the operating profit. All right, so you can kind of get mixed up the way that goes, right? Because you're taking it out of net income, which made my mind go, that's a subtraction problem. But that it was subtracted to get to net income, so we're adding it back in. We're going to compare that then to the net income, or to the interest expense of the 10,000, so that we can see how many times over we can pay the 10,000. So we'll take and so I'm going to add some decimals. Home tab numbers group, we'll add some decimals. So we can pay this over 16 times over. So remember that the interest is like the rent on the loan of the money. So from a banking perspective, the more times over we can pay the interest, the more safe they feel and the more likely they might be to loan us more money. So we're going to go then underline here. Let's underline that. So now we're going to do the same thing for B. But this is going a bit long here, so let's just prep for next time. We'll do that in another presentation. Before we do so, however, let's go ahead and unhide some of these cells so that in the next presentation we'll be ready to go with the Excel worksheet. So we're going to we have hidden cells, obviously, because we can see that, because if you go to the alphabet A, B, C, D, M, we're missing some. So we're going to then go from C. We'll put our cursor on C, left click, going to select over to M, so C to M, right click, and then we're going to be unhiding. So we'll unhide. And so there we have it. And these are the ratios we have thus far for company A. And then we'll do a similar item, a similar process for company B next time.